Welcome. My name is Jason Goodwin and I'm from Trade Debtor Finance Consultants. I have over 14 years experience in the industry, and over the next 20 to 30 minutes I'll be explaining all the ins and outs of factoring, debtor finance and invoice discounting. You can email questions throughout the webinar at any time. So let's get into it. Why do you use factoring? Most young businesses need capital to grow. There is only two types of ascertaining this capital. You personally putting the money in, or you borrow it. Overdraft, lines of credits, short-term lending, business loans all require some sort of personal security. You need great profit sheets, in equity in your business and strong balance sheets. Most young businesses would take these options because they are cheaper. And that's good, but unfortunately they don't grow with you. So once you grow your business to that particular level, unless the bank sees that and is comfortable with the risk that it's hand, normally they stay stagnant. And you just keep continuing to run your business with those fixed overdrafts or lines of credit until such time as you require more assets. Debtor finance. Debtor finance only requires strong debtors. If there's a spread, then the risk to the lender is down. In most cases, all they need to do a debtor finance deal is a personal guarantee. Now, unless you ask for stringent things to happen, like confidentiality or, one-on-one debting, you only want to factor so much, you don't want a lock-in contract, then property is normally not an option. Debtor finance has the flexibility to grow with your business as you grow. Because, let's face it, the more debtors that you ascertain, the more stock you get out there, the more invoices you provide, the more money the lender makes, the more money you make. I see a question there, just briefly, it just flew through on the email. Why are so many people scared of debtor finance or factoring? It was because about 20 years ago, when it first came into the country from the UK, there were certain companies that used it as a method of last resort. Now, the banks are traditionally favourites for overdrafts, lines of credits, business loans, surely because they really want to ascertain a business. They want the trading account, they want the directors, they want the directors' trading accounts, they want everything in one little nice, neat little bag. Well, back 20 years ago, it wasn't exactly like that. So when you couldn't get traditional lending because it was too tough, these little factoring firms popped their heads up, charging a ridiculous amount of interest rate, one-off fees and then interest rates that were over 36% per annum, and in some cases 72% per annum, and they were sending businesses broke right, left and centre. Now, unfortunately, in today's market, there is still some lenders out there that traditionally charge quite hefty for their fees, but that's what this webinar is all about today. It's about growing your business, not sending your business broke. And it's not a method of last resort. If any business is failing and they need to rob Peter to pay Paul, well, they need to rethink their whole strategy and avoid this product at any cost. Okay, the factoring and debtor finance products themselves. Most people will be waiting for this sort of rundown. There are over 45 lenders in the country, and they range from various products. But I and the business have been able to break them down into these sort of categories. Single invoice factoring, full service factoring, partnership factoring, confidential factoring, invoice discounting. Now, we'll start from the top because basically lenders use these terms, factoring, debtor finance, invoice discounting, but they all mean the same thing. It's just putting invoicing in and getting advances on them. Now, with invoice discounting, this was created by the banks because of the stigma around factoring, but discounting means exactly that. They discount it. So their fees are obviously going to be cheaper than any private lender out there, and where I mentioned before where they advance up to 80%, some banks might go to 90, 95. It just depends on the different scenarios, how big the client is, what the turnover is, and we'll get to that later on the track. But we'll start at the top. Single invoice factoring is exactly what it is. Putting an invoice in to a lender, a single invoice, and getting finance on it. Now there are some criteria that goes with this. It's not as simple as it sounds. Single invoice funders normally like large invoices. And when I say large, I mean it could be 20,000, 30 and above. They want one transaction. Now most of them won't take property. There'll be a personal guarantees. They'll actually have a look at the equity sheet and balance sheets and have a look at the directors, see what they own. But they're normally going off the face value and the strength of the invoice. Now, when all their eggs are in one basket, the risk is considerably amount higher. So what that means is that the lender can afford to put more in the sandwich, so to speak, and he or she will charge you more for that service. So on an average, if the debt goes out to 30, 40 days, it could cost you anywhere between 6 and 12% of the invoice value. I know there's going to be questions in and around these products, but we'll hold them off and just email through as you see fit. Full service factoring is the traditional one that's been around since ever. Full service factoring was pretty well where the business owners started their trade. The lenders would factor all the invoices that the client would have, put them into a normal 12-month contract, and would give them a 30-day grace, which meant that they would charge a fee between 3 and 5% for 30 days. In that block period, if the debt got paid, that was all the fees that they would require to be paid. But unfortunately, in most cases, the debtors would go past 30 days, maybe to 45, and that extra 15 days is where the lender makes most of their money, because they put a little interest charge on and they times it by the day. So 45 days, let's say it was an extra percent or 1.5%, add it to the 3 to 5, suddenly it's 6, 7. Very lucrative. Now, if it costs you 5% on a month on average, then that's 60% per annum. If you borrowed $1 million, that's $60,000. We start talking some real biscuits when the debtors continually go over 30 days. But over the years, these sort of businesses have been able to stay afloat because small mums and dad businesses don't have collection arms. And these particular full service products provide a service in the back end by themselves ringing up, verifying the invoices and collecting and doing all those things that honestly a two-man operation can't do. You know, mum normally handles the books, dad's normally out driving the truck or running his business or in sales or in marketing, and the factoring company becomes the back-end collection office, which for $60,000 a year you're hiring up to 10 staff to do that for you. And they do credit searches and all the rest of it. So if you look at it from that way, it's a very cheap product. But unfortunately, from a business point of view, it's very expensive.
Don't forget to click the link in the description for more information on this product.